Do you ever feel like you're swimming against the tide in the markets, struggling to catch the next big wave? Well, what if I told you there's a way to ride those waves effortlessly? You can do this by identifying a trend direction and learning how to draw trend lines. As we dive into this topic, don't worry if you don't catch everything the first time. This is a complex subject, and you might find it helpful to watch the video twice to fully understand all the concepts. Imagine you're a sailor navigating through stormy seas, trying to steer your ship towards a safe harbor. Just like a skilled captain relies on navigational tools to chart the course, traders depend on trend lines to navigate the unpredictable waters of the financial markets. Have you ever struggled to identify trends in the market? Share your experiences in the comments below. Now, let's consider the financial markets. Just like ocean waves, financial markets move in trends, offering countless opportunities for traders that know how to surf these waves. But how do you stay ahead of the game? That's where understanding trend lines comes in. By understanding trend lines and their relationship with price movements, traders can identify key levels within a trend. These are known as support and resistance levels. If you're interested in a more in-depth analysis on support and resistance levels, I've covered this topic in a previous video. You can find it at the top right of your screen. These levels provide valuable entry and exit points for trades, allowing traders to capitalize on market opportunities. Analyzing trend behavior enables traders to adapt their strategies accordingly, whether it involves trend following or counter-trend trading approaches. By mastering trend lines and trend identification techniques, traders can gain a comprehensive understanding of market behavior and anticipate potential trend reversals or continuations. Before we move on to the next part of how to identify trends and mastering trend lines, please take a moment to hit the like button and subscribe to the channel. This helps me to continue creating free content like this. Thank you. Let's continue. Trend lines are more than just lines on a chart. They're your roadmap to market success. By understanding trend behavior and mastering the art of trendline analysis, you'll gain a competitive edge in the trading arena. Imagine looking at a chart and seeing a series of peaks and troughs. These represent the highs and lows of price movements, signaling the direction of the trend. In an uptrend, prices consistently form higher highs and higher lows, while in a downtrend, they form lower highs and lower lows. We can then draw a trend line after we identify the trend direction. A trend line is simply a straight line drawn between two or more significant price points on a chart, representing the trend's direction. In an uptrend, a trend line is drawn below the price action, connecting the lows or bottoms of the price movements. This line acts as a support level, indicating the upward momentum of the trend. Conversely, in a downtrend, a trend line is drawn above the price action, connecting the highs or peaks of the price movements. This line serves as a resistance level, signaling the downward pressure on the trend. Let's consider a common mistake that traders often make when drawing trend lines. Suppose you're looking at a chart of company Z. You notice a series of higher highs and higher lows, indicating an uptrend. Excited, you quickly draw a trend line connecting the lows. However, you've drawn the line cutting through the price action instead of below it. This is a common mistake. A trend line in an uptrend should be drawn below the price action, acting as a support level. By cutting through the price action, you've invalidated the trend line, which could lead to inaccurate analysis and potential trading mistakes. Now, let's apply this to a chart of company X. Notice how the price forms a clear uptrend with higher highs and higher lows. By drawing a trend line connecting these lows, we create a visual guide that helps us ride the upward momentum of the trend. For example, a trader might decide to buy shares of company X when the price touches the trend line, expecting the price to bounce back up and continue the uptrend. So after the price touches the trend line, we wait for a candlestick to close above the previous candlestick as a confirmation that the trend might continue upwards. Now, let's demonstrate the example from start to finish. In this chart, we observe a shift from a downtrend, potentially moving into an uptrend. We note a low point followed by a higher high and a higher low, suggesting a possible uptrend. Subsequently, we see another higher high and higher low, prompting us to draw our trend line. The price then makes a new higher high and higher low, followed by another high that retraces back to our trend line. This could be a good entry point for a long position. The price also retests the previous low, providing another support line to bolster our confidence in going long. After the price bounces off the trend line and a large green candle closes above our bounce area, we can open 1 to 3 long positions. I've decided to go with 3 long positions, so we set our stop loss for all 3 positions below the support line at around 1.205, equating to 3.5%. To set the first take profit after opening the 3 long positions, we zoom out and look to our left. We identify a solid resistance area at around 130, setting our first take profit here. For the second position, we see another resistance area at around 1.335 before the highest point over here. So we set the second take profit at 1.335. For the third position, we trail the take profit each time a new high is established, positioning it below the most recent low or, for safer, below the trend line. We can now see that our first take profit was achieved, yielding a profit of 4.15%. We then trailed the stop loss for our 2 remaining positions below the latest low at around 1.25, which is also below the trend line. Our second take profit was hit at the 1.335 level, yielding a profit of 7%. We continued to trail our final position's stop loss below the trend line. The price continued its upward trajectory until we were eventually stopped out in the proximity of the 1.32 area, yielding a profit of 5.85%. In summary, we had 3 long positions that yielded profits of 4.15%, 7%, and 5.85%, each with a stop loss of 3.5%. Next, let's look at Company Y. If the price was making lower highs and lower lows, that would be a downtrend. And if we draw a line connecting these highs, we get a downtrend line. This line acts as a resistance level, signaling the downward pressure on the trend. In this case, a trader could consider a short sell when the price touches the trend line, anticipating that the price will retreat and continue the downtrend. So after the price touches the trend line, we wait for a candlestick to close below the previous candlestick as a confirmation that the trend might continue downwards. In this scenario, we observe a downtrend. We sketch a trend line, which initially has 3 to 4 touch points. Later, the price revisits and slightly surpasses this trend line. To our left, a previous support line has now become resistance, leading to a convergence of 2 resistance levels, resistance line and resistance trend line. After a candlestick closes below the bounce of the resistance trend line, we can initiate 1 to 3 short sell positions. We place our stop loss above our recent high, around 1.095. Upon opening 3 short positions, we set our first take profit at the 1.04 level. This level aligns with a significant support line visible on the left. For the second position, we can place it at the 1.015 level. That was a recent bounce on our left. For the third position, we can trail the take profit each time a new low is established, positioning it above the most recent lower high. As observed, the first target was achieved, yielding a 2.5% profit. We then adjusted the stop loss for our 2 positions above the new lower high, approximately at 1.062, or more conservatively, above the trend line at around 1.07. Our second take profit was hit at the 1.015 level, resulting in a 5% profit. We continued to adjust our final stop loss above the trend line. The price maintained its downward trajectory until we were eventually stopped out at around 0.91 area, securing a profit of about 15%. In summary, we had 3 positions that yielded profits of 2.5%, 5%, and 15%, each with a stop loss of 2.5%. Trend lines are not just lines on a chart. They're your secret weapon in the battle against market uncertainty. By mastering trend identification and trend line analysis, you can identify key support and resistance levels within a trend. These levels provide valuable entry and exit points for trades, allowing you to capitalize on market opportunities. Now, it's your turn. Pause the video here and look at this chart of Company A. Can you identify the trend? Try drawing the trend line. Remember, in an uptrend, the trend line should connect the lows and act as a support level. In a downtrend, it should connect the highs and act as a resistance level. Once you've drawn your trend line, resume the video. We'll go over the correct trend line and discuss how it can help us understand the market's direction. So that's how the trend line should be. Observe how the trend line is formed. You can spot 2 points of contact followed by a third one. At this third point, we could have initiated a short sell position or even two after the big red candlestick closed below the previous candlesticks, with a stop loss placed above our trend line, or even better, above the resistance level visible on our left. The take profit level is set at a particular point because if you glance to your left, you'll notice a support area and a trend line support converging at roughly the same location. This convergence makes it an ideal point to take profit for our first entry, while the second entry could be trailed until we get stopped out. Our first position quickly hit the profit target, and for our second position, we could trail our stop loss above the first take profit level. We then wait for another lower low, followed by a lower high, to trail our stop loss again. As you can see, we eventually got stopped out. The result? Our first position yielded a profit of 10%, and the second position a profit of around 16.5%, with a stop loss of 3.5% for each position. Quite impressive, isn't it? And that's a wrap on our journey through the world of Trendlines. We've explored how to identify trends, the importance of analyzing trend behavior, and the art of mastering trend lines. This knowledge allows you to capitalize on market opportunities and navigate the financial markets with confidence. Remember, these concepts can take some time to fully absorb, so don't hesitate to revisit this video. Watching it a second time might help solidify your understanding. Thank you for watching, and don't forget to like, subscribe, and share this video if you found it helpful. Stay tuned for our next video, where we'll dive into the topic of moving averages, another powerful tool in your trading arsenal. Until then, happy trading. Before you go, I'd like to recommend the broker I use, eToro. As one of the industry's leading brokers, eToro offers thousands of assets, transparent trading fees, speedy withdrawals, and a user-friendly interface. One standout feature is copy trading, which enables you to replicate the portfolios and trading strategies of successful investors with ease. You gain access to their trading statistics and history, and once you've copied them, you retain full control over your portfolio for any adjustments you wish to make. If you would like to have a look, click the free link in the description below.